Hello everyone, this is our uh, review of the answers to the practice for our inventory, specifically dollar value LIFO to start with, a problem having to do with Harbinger. Okay, so we're going to start with 2021. Whenever there's a dollar value LIFO problem, there has to be a base that we start from. And in this case, it's 2021, and we know the inventory at that point was 2,340,000. That is our reference point. And so in 2022, we count up our inventory at the end and we get 2535. But some of that fact that that's more than what we had at the end of 2021 is due to inflation, not because we actually have more products, but just because the prices of everything have gone up. So what we do is we take out of that the inflation. To do that, we note in the problem that it says that prices had risen 6% relative to our base or to our reference point. And so we take 106, see this 6% in there, and we divide 2,535,000 by 106, and we get 2,391,509. This is without inflation. So we divide and then take out the inflation. We note that even without the inflation, it is still more than what we ended 2021 with. So how much more? 51,509. That by definition is our new layer. So last in, first out. This is the last in. Okay, this is the new layer of inventory without inflation. Now, we don't just get to ignore inflation entirely. We take it out, and then we apply that same inflation rate to the new layer. So we just take the 51,509, multiply by 106 to get 54,400. Okay, that is our new layer with the inflation put back in. So we just put the inflation on the part that has been added because that's what it would apply to during this new year, this new layer. So we add that. So in here, to get our ending at 2022 inventory, we add our beginning, right? And the new layer, 54,600 with the inflation, just on the new layer added back in. So that's your ending of 2022. Okay, so in 2023, we count up our inventory. We get, based on the prices we have now, the costs that we have, 2,741,000. That's 9% higher than our reference point. So we divide it by 1.09 or 109%, however you like to do it, and get 2,514,000. Okay, that is compared to the last time we took out inflation. And this is the tricky part. This is the part we sometimes forget. We compare it to this number, and we shouldn't do that. We should compare it to this 2391. Okay, and the difference is 123,169. So we're take out the inflation, and then we compare it to the last time we took out inflation. Not to what our final result was, but to the last time we took out inflation. 123,169 is our new layer. So our inventory at the end of 2023 is the original plus the layer from 2022 plus our new layer, which is the 123,169 times the inflation for the 2023 year to get 134,255. Okay, so you only multiply that new layer by the new measure of inflation. So our ending inventory on the balance sheet is 2,528,855. That's what it was at the end of 2022. This is what it is at the end of 2023. Moving forward to 2024, Our inventory, you can see, even without considering inflation, has gone down. Okay? So we still do the same thing, divided by the new inflation rate, 1.11 or 111%, to get 2,349,550 without inflation. Now, that is less than the last time we took out inflation. So there's no new layer. See, if this up here, we had more than the last time we took out inflation, so that's why we added the layer. But this one is less. So 2023 is now gone away. We have had what's called a LIFO liquidation, and a layer has been stripped away, and will never is never going to come back. 2023 is now no longer involved in our process of calculating the inventory. In fact, it's even less than what we came up with here. So if you compare it to the very beginning, we only have this very small layer left of 95,550. That's compared to the beginning clear back at the end of 2021, our reference point. Okay? So it came out with inflation, and we see how low that was. So that layer that's left is only 95.50, and it's a 2022 layer. Okay? Because everything, remember, LIFO, last in, first out, we sold everything in 2020 we bought in 2024. We've sold everything we bought in 2023. And we've sold most of what we bought in 2022, reference point, except for 9,550 from 2022. That is at the rate for 2022, 106. So multiply that by 106, get 10, 123. So we take the 249,550 plus the 10, 123, and that's our ending balance on the inventory on the balance sheet. Now, the question asked, furthermore, how do you get the cost of goods sold for 2023 and the gross profit? Well, the formula for inventory is beginning inventory. So beginning 2023 is really the ending for 2022, 2,394,600. Add the purchases which were given in the problem, subtract the ending of 2023 to get our cost of goods sold, 7,800,745. Sales were given. We subtract the cost of goods sold to get our gross profit. So that wraps up that problem and how we should go about doing it. Oh, the other problem is having to do with lower of cost or market. So we've got these three items. We've printed a report. We indicate that these have not sold for quite a while. We do some investigation. We find out that there's some reasons why that these are not selling, and that is, and nothing's going to change soon. So we realize that there's a problem, and we need to recognize and look at the possibility of having to record lower inventory based on this scenario where we can't sell these, at least not at the price that we originally planned on, and maybe even for less than it costs us. Now, these haven't actually sold yet at the end of the year, but we're looking at the possibility that they are really not sellable at the regular price. So investigation indicates that if we can find a market for them, if we look hard, requiring to find some new customers outside our normal customer base, and they are willing to pay $240 if we do some special work on them to get them ready to go to their market. That's going to cost us $35. So we're going to get out of it $205 each for all of these items. So that becomes our net realizable value for these. The original cost is considerably higher than that. So the lower of cost or market, when we compare what we can sell them for, the net realizable value to the cost, the lower of the two is what we can sell them for minus the cost to get it there. And we take that, we figure out the loss. The loss is the difference between the original cost and our lower of cost or market. And then we multiply it by the 6 because we lose that much on each of the items. And that gets to be 906. And if we do the same thing with others, it's 21, it's 10, and it's 2160. Now on the last one, the original cost 148, and we can still get 150 after the cost to sell them. And so we stay with the cost and we have no loss, because as long as the net realizable value, what we can sell them for, is more than the cost, we do not need to make a loss adjustment. So that leaves us with the other two. Add together. You could make a separate journal entry for each item if you wanted to, but most of the time we'll just add these together, these two adjustments, and make one journal entry for 3,066 by debiting cost of goods sold and credit inventory, 3,066. Now that is going to lower our inventory down to this 205 for these ones. All right. So when we sell these ones that we had a loss on, just the ones that were loss on, we're going to sell them for 205. We're going to sell 16 essentially at 205. And that's going to give us cash of 3280 and credit sales of 3280. Again, you could do two journal entries for each of the items if you want to do them separately. And in this interesting case, the cost of goods sold, because the cost and the value are exactly the same, or should be if we did this whole thing correctly, our cost of goods sold is going to be the same as sales. So literally you're selling it for exactly this cost. We make no profit. That is how the GAAP is designed, is said when we're done with this, when we sell these, they should net us 0 gross profit. We're selling them for what their adjusted cost is.